You are listening to KeyStone Stock Talk Show, episode 179.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment, and we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back again this week. The bear ripped into the market again last week, and we touch on a number of hot button topics this week, including the U.S. Federal Reserve moving rates higher once again, Canadian inflation numbers, an update on SPAC performance year to date. Hint, it is not good. The pound falling to all-time lows next to the dollar, and what appears to be billions of capital sitting on the sidelines. In our Your Stock Our Take segment, Aaron answers a question on Adobe Inc., symbol ADBE on the NASDAQ, the well-known provider of content creation, document management, and digital marketing and advertising software and services to creative professionals and marketers across the globe. Brennan answers a client question comparing two U.S. healthcare-related stocks, United Health Group Inc., symbol UNH on the New York Stock Exchange, and CVS Health Corp., symbol CVS on the New York Stock Exchange as well. In our Stars and Dogs segment, Brett takes a look at Star, Canadian manufacturer and distributor of high-quality packaging materials and related packaging machines. That would be Winpak, symbol WPK on the TSX. A team we actually interviewed this past week. And Nautilus Inc., the pandemic star, which turned dog, seeing its share price plummet over 90% from its highs. Finally, if we have time, I will complete Howard Marks' thoughts on the folly of macro forecasts this week. I'd like to welcome my co-hosts, Aaron and the Killer Bees, Brennan and Brett. How you guys doing?
Salutations. Gentlemen. Good. It's
Good
quite
week.
A show. It's quite a lineup.
That's a lot of crap to get to. We better start hitting it, right? Maybe some of it'll stick if we throw it hard enough at the wall. What do you think?
We'll see.
I think so.
We'll see.
Well, the Fed hiked rates again last week. To no one's surprise here, midweek, the U.S. Federal Reserve raised the benchmark interest rate by another 0.75 percentage points and indicated it will keep hiking rates well above the current level. The central bank has been looking to bring down inflation, which is running near its highest level since the early 1980s. Fed officials signaled the intention of continuing to hike until the Fed funds level hits a terminal rate or endpoint of 4.6% in 2023. That implies a quarter point raise next year, but no decreases at this point. They remained very vigilant on the inflation front. You guys have any comments there? I know I actually watched a video and some comments from Wharton professor Jeremy Siegel, who had some harsh criticisms of the Fed. Any comments here, and I'll get into what he said in a second.
Yeah, sure, I'd be interested to hear what he said. It's
okay. Well, he was basically. Brandon, do you got something? You got?
No, I was just going to say I think you should get into it. I just get into it. I think that it's an interesting discussion.
Yeah, I mean, he talked about accused the Fed, the rate setters, of making one of the biggest policy mistakes in its 110-year history. Jeremy Siegel, he's a Wharton professor, University of Pennsylvania, comments on CNBC quite frequently. I'll quote him directly here. He said, "I think we're giving Powell too much praise. The last 2 years are one of the biggest policy mistakes in the 110-year history of the Fed, by staying so easy when everything was booming." Now, he said he argued that the Fed made a massive policy mistake essentially last year by not moving to tighten monetary policy before inflation got out of hand. And he mocked the Fed and Powell for insisting inflation would quickly fade on its own. Now, Siegel said that the Fed is making another mistake by raising rates and tightening monetary policy too aggressively. So he said when economy or commodity prices were all going up at rapid rates, the Fed Chairman Powell said, we don't see inflation. We see no need to raise rates in 2022. Now, all those very same commodities and asset prices are going down. Stubborn inflation, Powell is saying stubborn inflation requires the Fed to stay tight all the way through 2023. He said it makes absolutely no sense to me whatsoever. He said, really what is happening here is the central bank is making working and middle-class Americans pay what he expects will be through a punishing recession that is upcoming. So that's his argument. Behind the curve, I mean, many people, I don't think it's a fresh argument saying the Fed was behind the curve in terms of getting ahead of it, raising rates when inflation was really rising.
But he's saying now that the Fed should raise rates, but just not as aggressively as they've been doing. So
I think he thinks they should stop.
Like 25 basis point increase.
Yeah, he went on to talk about letting falling commodity prices shoulder the inflation fighting burden. Really, crude oil prices have fallen sharply from their highs.
They have.
So all of the commodities now coming down should help fight inflation as well. The part of it is are the markets spooked because of the aggressive rate hiking too that's bringing these things down. So I mean, chicken and egg. I'm not really sure, but yeah. Could this now bring on a bigger recession than we would have had, or a recession we would not have had because of the rate hikes? And that's he's saying, it's going to bring on a harsh recession because of those hikes and the aggressiveness of them.
Yes, I think that it's basically it's almost a foregone conclusion that we're going to go into a recession, and many think that we're already there. I disagree, really, because in terms of the employment situation, it's still incredibly strong. So how can you say that we're in a recession? I'd be curious, was he on record a year ago advocating for the Fed to start tightening then, or is he just kind of looking in retrospect?
Yeah, I'd have to look back at a record. I'm just reading from an article. So, you want to see someone's track record on something like that. Are we, using 2020 hindsight here? Are we using?
I know that in the 80s, the last time we had extreme inflation here in North America, one of the things that the central banks at that time were criticized for was not raising fast enough, or they would raise and then they would kind of wait and see what was happening because they didn't want to push the economy into recession. Whereas now I think they're taking, maybe you could argue that they're making a mistake. Maybe you can argue that they learned from that. I really have no idea what's going on in their heads. I'm not going to pretend to, but it seems like they're taking the opposite approach where they just want to go as aggressive as possible in order to create that, economic shock. And then once they start to see the economy go into recession, rates start coming down maybe almost as quickly to an extent as they went up.
Yeah, it looks
work?
like.
I mean, who knows? Like the ultimate where we're going is certainly recession. I mean, you're looking at where rates are. I mean, you just think about consumer spending, right? Like what is like what do you have to pay on a line of credit right now? What do most people have to pay? I don't know, like 6, 7, 8%. I have no idea, but a lot more. A good 3-4 percentage points more.
Depends on who you are.
Than they were a year ago, right? So you just can't spend as much, right? Like your mortgage, if it's renewing, is more expensive, or if you're on a variable, your credit card bill is more expensive. Anything you purchase on debt is more expensive. So obviously that's going to pull back the reins. Now, it's the hope is that they get it right and they pinpoint it, but they almost never do, right? I mean, typically a recession is caused by tightening because the economy, Fed tightening or central bank tightening because the economy gets overheated, so they have to pull back the reins. And they want to pull back the reins only strong enough to basically slow the economy down and not bring it into a hard recession. But that's an incredibly difficult thing to do. In terms of should they have been tightening a year ago? I mean, yeah, I think for sure. Right when they saw any sign of inflation or strong inflation, rather than try and second guess it and say, we don't think this is going to be persistent inflation. We think it's transitory. You're already at like record low rates, you should have been tightening back then, at least to an extent.
Yeah.
But that's all retrospect now. So all that matters is what they do going forward. Did they know what they're doing? No, I don't think that they know what they're doing. I'm not sure anybody would know what they're doing.
Yeah. It's hard to be ahead of the curve.
But I definitely
No, and that's
Brennan?
It's hard to be ahead of the curve. Like that's the thing.
It is. Yeah. It's
And I mean, and we'll get to the folly of macro predictions. They're making massive macro predictions with like millions of data points that they have to take into account to see which way the economy is going to go. And now they're trying to act on that. I mean, even though they're in possession of a ton of data, will they make the exact correct decision? I mean, they didn't clearly at the start of this year. Will they now? They'll probably go too far. They probably will go too harsh, and it probably will. But I mean, I think that if we want to go digress, the failure of this entire period, the last 10 plus years on governments, policymakers, people in general, is not permitting any pain in the economy over this period. Just easing everything, allowing.
It's 4-year election cycle. That's
I mean, it's just it's disgusting.
Of that 4 years.
We need to be. The economy, businesses, individuals, government need to go through pain to learn, okay, we cannot spend to excess, right? We cannot borrow as much as we borrow. And, there's it's a whole generation that has not gone through anything close to austerity out of their politicians, out of the Fed, to be honest. And it'll probably be worse this time, because we didn't go through anything that came close to some pain in your wallet, right? And you need that. I think people need to get slapped with that. Politicians don't want to go through that because people vote them out based on a poor economic cycle. But in the past, we seemed to have leaders that would be able to communicate that properly, and we went through cycles, and they were able to stay in power. I think that people have to take responsibility. Politicians, all of us have to take responsibility, and we may have to see some belt tightening. I mean, we should see some belt tightening going.
And we're going to touch on that after too, with the pound hitting a record low, first $1. We'll get into why that's taking place, and it's basically just reiterates what Ryan just said. These policymakers maybe making policies for their best interest rather than, everyone's long-term best interest.
Yeah. I think some of them believe they're well-intended. They won't want people to go through any pain, but sometimes you have to experience pain. Just like when you have a child, like sometimes you want to guard them, protect them from everything out there. But sometimes the best thing is they have to experience these things, and they may be negative in the short term, but they learn from it. And the economy as a whole, individuals haven't learned any pain for 10 plus years, really. And I think, I know nobody wants to go through it, but it's probably beneficial for some people to go through that and learn we just cannot spend to excess. When we're investing, we just cannot pay anything for any stock, even if we love it. All of these things may have to be learned in a more painful way. And the market's down this year 20% for the first 6 months. That is the worst first half of the year in like 50 years. Like, that is a harsh decline that we've experienced in the markets. It could get worse before it gets better. We're going to still look at the same great businesses that we continue to look for our clients that are long-term. And there's going to be some great opportunities. And it actually gets me excited because, we have cash sitting on the sidelines. I'd love to deploy it. There's going to be some great opportunities coming forward. It's just, we'll wait for them and then we'll pounce on them when we can. And not try to get too cute. There's some good companies that you want to buy right now. You don't want to just wait until you think, oh, this is the bottom, trying to predict that is folly. So, you got your watch list of companies that you want to buy, and look at them right now. And they're starting making some positions too. But as far as like what has this done, the rate hikes, well, we did see some data points last week. Inflation in Canada slowed in August. It's up 7% annually for the month. That is down. It's still a shockingly high rate, but the trend does seem to be moving lower. We saw Statistics Canada release retail sales. They fell 2.5% in July. So you're seeing falling retail sales there. which should be expected in this environment. So, like Jeremy Siegel said, I believe, it does look like things are rolling over a bit. So, is that because of the Fed? Is that, because it was naturally going to happen? It's probably a combination of the two.
Yeah.
Now, what do we want to touch on next? Do we want to look at SPAC?
Going to the pound?
Or the pound, yeah, let's go to the pound.
Yeah, going to the pound.
The pound was absolutely pounded, right?
Yeah, exactly. No, I can do a quick rundown.
Fine.
So the pound and the euro have been kind of connected over the last year or so, it's not unexpected. The two currencies move in tandem quite closely. First off, they were being hit hard with the invasion of Ukraine. Commodity prices go up, which ties us back to inflation. The central banks kind of got scared a bit, to say the least, which we went over the last 15 minutes or so. And then most recently now, though, the pound has dramatically fallen. It's like 10 cents compared to the dollar overnight, pretty much, since the UK government implemented their new budget plan of cutting taxes into high inflation. The market does not like this. No. So I know Brennan had some comments on this.
Yeah, well, exactly. I mean, it doesn't need too much to be said, where I just don't know if that's the right thing. There's two things to do to combat inflation. It's either raise interest rates or, reduce spending and, raise taxes, essentially, slow down the economy a bit. I don't know if, canceling a rise in corporate tax rate as well as reducing basic income tax in the UK is the best thing to do while the country is dealing with decade high inflation. Now, I believe that they actually indicated that, or they came out and said that they are in a recession. That's what they said. So they want to stimulate growth right now. I don't know. Like we were just talking about, sometimes it's good for some pain. My mom was a helicopter parent. She never exerted me to any pain. Look at how I turned out. Just kidding. Not funny.
No, nobody's got any comment on that. Sometimes when you got
truth.
My mom told me when you don't have anything nice to say, just don't speak. So that's why
I'm
nobody
joking.
spoke
My mom
there,
was not a helicopter parent. She raised me.
And your mom's a saint, right?
Colleen's
what is your mom gonna think when she sees this episode?
When she listens to, we're the one thing saying she's amazing.
Not a helicopter.
Let's be serious. She started ignoring Brennan years ago, so she's never gonna see the episode.
True.
Yes.
Brennan can
pick
say
up the
whatever
phone.
he wants.
She won't pick up.
No,
the phone.
and No. I just have to disagree. Cutting taxes is good at all times. So I don't know.
So let me be clear here. Sorry, they're canceling a scheduled increase in corporate taxes. Correct. Okay, so they're not going to increase corporate tax, and they're going to cut.
And they are reducing basic income tax. Correct.
Yeah.
And then there were some other initiatives that they were going to do too. But I don't know exactly what they are, but they were in the article.
Yeah.
But go on, Aaron.
Mm-hmm. It's just their mini budget. It's not their full budget yet, because their new PM just got elected a couple weeks ago. So this is, I think, a decade or so of the same party. So it's not like a shift from a left-wing party to a right-wing party where you would expect that sort of thing. It's the same party, just a different PM. So it's quite a big shift in policy just from a leader change.
Yeah, well, the Queen wouldn't allow any of this to happen. So you know that, right?
Oh yeah,
she wouldn't have stood for this. I question right now, what is King Charles doing? That's the issue.
Is that where we're gonna go?
Yeah, that's really no. Yeah. Let's just not touch any of that. No, I mean we'll continue to watch. I mean, this has strengthened the U.S. dollar too. It's a flight to.
And you would think, that the U.S. dollar has been strong because there's a lot of uncertainty in the world. Commodity prices are higher. The commodities are traded in U.S. dollars, so that puts some pressure, or at least oil prices were higher. But there's just general uncertainty in the economy causes more people to want to own U.S. dollars as opposed to other currencies.
Yeah, people flock to.
And you have to think that they've changed leaders in the UK now. Seems like half a dozen times over the last couple of years. So they're rivaling the leadership turnover in the Canadian Conservative Party. I don't know.
We were both just over in the UK, so maybe.
Yeah, my only issue, my big issue is why wasn't the pound at this level when I was?
So that's why it's crashing. You two are the cause.
We left. We were there and left. We stopped spending there. Yeah, that's
okay. Yeah, Mr. No taxes here. bringing in all of the big bucks. That's what's going on.
It's
But,
not true. So do you want to get to the SPAC king? The reason I'm so eager to get to this, one of my predictions at the start of the year was the SPAC market again. Companies, it's not really a sector, but a segment. Companies that raised money this route, the blank check route, I said would continue to be a poor area to be involved with. There was an article I read, down goes the SPAC king. And I think his name is Chamath Palihapith. I can't say it.
Yeah, I don't want to.
I'll put his face up in the name or something.
Chamath is what I call him. His name became synonymous with. I'm laughing at myself, not his name. I just want to put that out there for sure, because I can't pronounce it. With special purpose acquisition SPACs or blank check companies, just as the momentum for high growth risk assets was hitting its stride, essentially. Now, unfortunately for him, what goes up often comes down. And let's be honest, he made boatloads of money in this sector. So I think Chamath we shouldn't be shedding one tear for him. He's done incredibly well. But the SPAC king this past week, that he shuttered 2 of his blank check firms, which raised over $1.1 billion from investors. So he cited valuations and volatility as the 2 biggest obstacles in closing deals. So, I mean, to me, I mean, valuations have come down. So, there could be, and I would still say in some segments of the tech, they're still too high, but they couldn't close deals. So that money gets returned to the original investors. Just to track how SPACs, companies that have raised money in the US via this route, have done from their highs. The DSPAC index, it tracks companies that successfully merged with a target. So went public via this route, essentially. It is down, that index is down 82% from its 2021 peak. Roughly a quarter of stocks are trading under $2. But there's over 550 still SPACs holding over 150 billion in cash that needs a home before their deadlines hit. You raise money through a SPAC, and then you have to do, like, it's in Canada, we call them qualifying transactions. It's basically you have to take that cash and invest it in a business before a deadline hits. Now, that money's just sitting there. So there may be more of these, of this cash returned. And it plays into another topic that we're talking about. I think Brad had an article about a ton of cash sitting on the sidelines. Well, there's a ton of cash sitting in these SPACs, no places to go. I mean, to me, and you can get into the article, Brett, in a sec, but it does seem to suggest there may be, as prices come down, maybe end of year or into next year, some M&A activity in the market. You would think that would pick up. Prices come lower, cash sitting there in some investment vehicles that need to buy assets, buy businesses, and also just investors holding cash right now. So there could be some acquisitions, or M&A activity could pick up. It would certainly be a better time for M&A. Honestly, we see more M&A activity at the peak in a cycle, which is just, is bass backwards, right? Like, you should not be making more acquisitions at the peak of a cycle. You should be making those. And it actually sometimes gets quieter. Maybe this time there'll be some money sitting on the sidelines, but it tends to be harder for people, and I don't know if it's a human condition, to pull the trigger when things are lower or going down, but it is the right decision in the long term.
It's also just from the perspective of the acquiring company. You typically do acquisitions when capital is available and when capital is cheaper, right? And that's when the market is hot, when we're around the market top, when things are most expensive. Yeah. So it's it's a bit of it's somewhat ironic that, the time that the acquirers are in the best position to make acquisitions is often the time that the acquisition quality based on price is the lowest as well. But it's kind of crazy. And I think you'd agree, Ryan, that we're talking about SPACs even as like a sector or a theme, because it's really not. It's just a structure of a business. It's just a way to take a company public, in a more simplified form than your standard IPO, right? So ultimately, you could have companies that are in technology, in agriculture, in all sorts of different industries, and really you need to just evaluate it based on what market the company's operating and what type of a business it is. The fact that it's a SPAC, I mean, yeah, people got excited because there's a period of time.
Well,
in the
they
market,
saw headlines.
Everything was going up.
Yeah.
Yeah,
they
exactly.
saw headlines. I made this much. This SPAC jumped this much right when it IPO'd. But here's the cold hard data.
362 or whoever's that crypto guy that you
made a ton of money. Yeah,
yeah, he made a ton of money on it, and
but the thing is,
362 can.
The cold hard data though shows like from its highs down 82%. That's just the average of all those companies that use that methodology, raised capital that way, that structure, and from their highs in 2021 down 82%, having made a transaction and gone public that route. Just shocking destruction of capital for people who were investing right when those companies went public. It's a cautionary tale. You're not investing in a company because of its structure, because it was a SPAC. You're investing in that for the business at that point in time, growth prospects going forward, current valuations, and those things were thrown out the window to just, here's a big name involved with a SPAC. Let's get involved with this. A ton of euphoria, and it just ends up being a recipe for disaster. Now, what may happen here, I think, because we interviewed one of these firms in LA just in the spring, and they have a ton of cash. They've kind of been painted with the same brush as the entire segment, but they are growing now. There's a ton of cash in the bank. The share price has been beaten down, and there may be a few these babies in that sector that were good businesses that were acquired that now get beaten down, and you may be able to look at them at low prices. That is when we will look at a company more closely. And there's, a couple that we're monitoring right now that look to have good businesses that they bought, and they happen to raise quite a bit of money, so they have net cash positions. But the market has been beating the hell out of them because, people bought at inflated prices, and also just being associated with a SPAC is bad. So, you get. Eventually it shakes out. That business it won't matter which way the company went public, but we may get an opportunity to buy some of these companies at a discount, which will be great to see. Okay, so do we want to get into our Eurostock, our take? I think we've exhausted our hot button issues.
Yep.
So Aaron's got a segment on Adobe. It's a company we monitor closely. They had a rather large acquisition over the past week that was at very pricey multiples. And, the multiples were a bit concerning. So Aaron's going to answer a question from a viewer on Adobe.
It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Right. So I'm happy to do that because, as Ryan said, Adobe is a company that we follow quite closely. We've been doing a lot of tech research, companies that are good, solid, recurring revenue businesses, SaaS model businesses that have come off in many cases 50, 60, 70, 80%. We're looking at these names for potential entry points. But onto the Your Stock, Our Take. Adobe Inc. Trades under the symbol ADBE on the NASDAQ. It's at a share price of $280. And a market cap of about 130 billion. So Adobe is an extremely well-known company, a subscription software for content creation, document management, and digital marketing. They have a wide range of products, way too many for me to mention, but three of the top ones are Adobe Photoshop, Adobe Illustrator, and Adobe InDesign. So Adobe was one of the top performing stocks in the tech sector up until the sector peaked in 2021. So if you look at this company over the past 10 years, it's up 23 times. The share price is up 23 times. Since it's hit a peak, however, in November of 2021, the stock price has declined 60%. And it's actually dropped about 30% just over the last couple of weeks after they announced that they would acquire Figma, a leading web-first collaborative design platform for approximately $20 billion, about half stock, about half cash. So what's going on with the company right now? Why all the negative momentum? Let's take a look at the recent financial performance. So at face value, recent financial performance was relatively good, about 13% growth in total revenue in the most recent quarter, Q3, up to 4.4 billion. About 13% as well growth in subscription revenue. So subscription revenue is about 90% of total revenue. And that's one of the great things about Adobe, is that it does have that subscription model. Operating income, on the other hand, up about 3%, so basically flat. Operating margin was down slightly to 33.5% from 36.6%. And then earnings per share down about 5%. Historically, the company has had a tremendous track record of financial success, 7 consecutive years of revenue growth, growth averaging over this period about 20% annually. And the company grew the revenue by 23% in 2021 last year. And if you look at analyst expectations, they do expect some growth to continue over the next year. Analysts are expecting about $13.60 per share in earnings for 2020 for the current fiscal year. So that's up about 9%. And then going to next fiscal year, analysts are expecting 15% growth to about $15.60 per share is the consensus. So right now, based on current year's expected earnings, Adobe's trading at a valuation of 22 times, price to earnings valuation of 22 times. So this is very cheap compared to the company's historical range. When it peaked in November, the company was trading at a valuation of about 65 to 70 times its trailing earnings per share. But if we look back over, say, the past 5 years or so, it's averaged up around, I'd say the 40 to 50 times range. So at about 20 times current expected earnings, it's looking very cheap. So the recent news, which led to the 30% decline in the share price, is, of course, the acquisition, $20 billion acquisition of Figma. This was not received positively by the market. According to Adobe, Figma has a addressable market of about 16 billion by 2025. Companies expected to add about more than 400 million in annual recurring revenue as they exit 2022. Gross margins of Figma were about 90%, and operating cash flow was positive. No mention about profitability. The company did say that they expect the acquisition to close in 2023 and that they expect the transaction to be accretive to Adobe's non-GAAP earnings per share by the end of year 3. So not immediately accretive, but by the end of year 3, they expect it to be accretive. And, this is somewhat of an issue I find myself when the growth expectation or the profitability expectation is several years out, because you really don't know what's going to happen 2 to 3 years from now, right? So it's when you're making an acquisition that's not going to be fairly immediately accretive or accretive within the first year, there's certainly an element of risk that introduces. So what is our take on Adobe? Well, let's look at the pros and the cons. Adobe has very strong competitive advantages. It has the proverbial competitive moat. So where they dominate, like in Photoshop, Illustrator, Adobe Acrobat, they have very strong competitive positions there. Now, it's a recurring revenue business. It has that SaaS model. These types of companies are generally preferred in the market because there's more stable, more predictable revenue streams. We like that. High margins. It's a highly profitable business. Analysts do expect the company to continue to grow its earnings per share over the next year. And of course, that valuation, very cheap right now relative to the historical range. But what are the cons? Well, one of the cons is that the growth is slowing. So Adobe really benefited from the pandemic boom. So everything digital, almost anything digital, there was a huge spike in demand during the pandemic, and certainly in the content creation space. And so Adobe benefited from that. They produced a lot of growth. Now we're certainly seeing that growth slowing as we come out of the pandemic. And there's also the recession fears and investor concerns about how the company would fare during a recession. We've seen some margin compression. And then there's the acquisition of Figma. So what do we have here? So Figma, based on the acquisition price and the company's expected exit annual recurring revenue for the current year, they're basically paying 50 times sales for Figma. So this is a very high acquisition price, very high valuation price. It's really reminiscent of the peak valuations that we saw late last year in the tech sector and the software sector. And we've seen what's happened to those valuations since then. We thought they were too high. And then when the market eventually figured that out, stock prices have absolutely crashed in that area. So I think that there's a lot of smoke right now with the Figma acquisition. It may be a good move for the company to make long term. I know they've been very active with acquisitions over the past couple of years. One of the strategies is like, rather than compete with some of these companies, why not just buy them out? But certainly there's a lot of smoke right now with this acquisition. The market did not like it. So it'd be good to see some of that smoke clear. And of course, there's very negative share price momentum. Part of that was due to the acquisition. Part of it is just due to some of the concerns generally in the software sector right now in the US. But it's really a situation where we don't see any major hurry for somebody to rush in with a full position when we see the stock essentially making 52-week lows quite repeatedly here. So what is our conclusion on the company? Well, ultimately, Adobe is a very fundamentally strong company, excellent track record, great balance sheet, cash-rich balance sheet. So fundamentally, financially, it's a great stock. It does appear to offer an attractive investment opportunity long-term. So if you're looking for this as a long-term investment, to take some money, put it into a beaten down technology leader that has very strong market position in its areas, a lot of competitive advantages, then we do see an opportunity in Adobe. However, there are near-term risks, slowing growth, some smoke regarding the recent acquisition. There's that negative share price momentum. So there are some near-term risks that could further impact the company in the near term, and investors have to be prepared for that. For anybody who wants to build a position in Adobe, I do think that it's a great stock long term. But what we would say is you don't necessarily have to rush in with a full position. You can start small in this company, take a small position, and then look to gradually build that position size up over time as the company comes out with a few more quarters and we get some revised updates to the outlook. So that's all I have to say about Adobe. What do you guys think?
Yeah, I think it's a really good summary. I don't know if I have a ton to add. I mean, I think I like the business. I think it was expensive and it's come down, but the Figma acquisition, the price tag of that worries me in the short term. And
yeah, I mean, just to put it into perspective, so they're paying about 50 times sales. At least based on the annual recurring revenue. If there's more revenue outside of that, they haven't disclosed it. So I'm assuming that that's all of Figma's revenue. But Adobe itself trades for only about 8 times sales, right? And there wasn't any mention really, like they did mention the margins and the cash flow, that cash flow was positive for Figma, but there's no mention in terms of profitability or the net profit margin. So, the fact that they're not expecting it to be accretive for at least 3 years, and who knows really if it's going to even be accretive then, that's definitely some risks involved. But I think it is a great company for what looks like a very attractive price right now. I just think that there could be some further near-term downside in the stock price, and that's just something that any potential investors need to be aware of. Overall, I'd give it right now probably 4 to 4.5 stars out of 5 kind of thing.
Nice.
Okay. Do we want to move on to Brennan's comparison?
Let's do it.
Sure, let's do that. You're looking at 2 U.S. healthcare, CVS and United Health, right?
That is correct. Yes. So we had a question come in from our U.S. growth stock chat last week to compare United Health Group, UNH on the New York Stock Exchange, and CVS Health Corp, CVS on the New York Stock Exchange as well. I emailed this client with my response, but I thought with all of the work that I did, it would maybe be beneficial to some other people as well. So UNH
showing us how much work he did.
Yes, exactly.
Basically,
yes.
Yeah. Look, I did work.
I'm doing work, I swear.
See, I like this though, because a lot of times we do get questions by email from clients, and then we put a fair amount of work in answering that question. And it would be beneficial to more people, but it usually only goes to one person. So it's good now that we have this format so that we can. Anyways, Brennan, go ahead.
Totally. Thank you. So yeah, United Health Group Inc., UNH on the New York Stock Exchange. This is one of the largest private health insurers providing medical benefits. Along with its insurance, the company has its Optum franchises, which provide healthcare services from medical and pharmaceutical benefits to providing outpatient care and analytics. CVS Health Corp is pretty similar. CVS on the New York Stock Exchange. It offers traditional, voluntary, and consumer-directed health insurance products and related services, essentially benefits. And then they also have their sizable pharmacy operation, which includes nearly 9,900 retail pharmacy locations, primarily in the US. So I'm just going to kind of go slot for slot between each company, depending on what we're talking about. So UNH right now trades at a price of about $508 per share and has a $476.4 billion market cap. So it is a much larger business, whereas CVS trades at $97 approximately per share and has a market cap of about $128.5 billion. Now, UNH does pay a lower dividend yield of just 1.3% compared to CVS's yield of about 2.3%. And both of them had a payout ratio of 25% in the last quarter. That's just a coincidence. Looking at the long-term historical growth, this is a revenue growth rate. UNH had a compound annual growth rate of 9.3% from 2017 to 2021, whereas CVS's was about 12% over the same period. So CVS is growing top-line revenue at a slightly better pace. And in the last quarter, net income was up 18.8% for UNH, where for CVS, it was only up 6%. Now, looking at the balance sheet, UNH has a much healthier balance sheet with net debt of about $23.4 billion and a net debt to EBITDA multiple of about 0.4 times. This is in comparison to CVS's net debt of about $59.2 billion and a net debt to EBITDA multiple of about 3.2 times. Looking forward for guidance, both provided full year GAAP EPS guidance for fiscal 2022. And looking at the year over year growth, this would, if they can hit their targets, this would equate to about 13% EPS growth for UNH, whereas CVS is guiding to about 24% growth over 2021. And quickly, just looking at the valuations, UNH has a forward PE multiple of about 25 times, where CVS's is 14 times. UNH has a 12 trailing month enterprise value to EBITDA multiple of 9.2 times, whereas CVS's is 10.4 times. And looking at the PEG ratio, or price earnings to growth ratio, this is essentially seeing if a company offers growth at a reasonable price. Essentially, UNH trades at 1.9 times, whereas CVS has a 0.6 times PEG ratio. So to conclude, both are quality businesses. CVS has historically grown revenue at a better rate, pays a better dividend yield, is guiding towards better earnings growth this year, has more attractive valuations in relation to growth. But the one negative of the company is that it is quite levered up. I would say that the debt is sustainable, but it is getting to the higher end of where we would like to see it. And then just keeping in mind, it is also a smaller company compared to UNH. Now, UNH, they have much less debt, but certainly trade at more of a premium given its earnings growth guidance. Personally speaking, I think that I would go with CVS, given the better dividend yield and profile that closer fits growth at a reasonable price. But it's pretty close. It's tough. Especially looking at the debt load of CVS, the risk is definitely higher with that company. So yeah, it's a tough one. It is a tough one. But yeah, I'd like to open it up to Ryan, Aaron, and Brett and see if they agree with my analysis. Potentially.
So which one
CVS.
would you buy?
I would go with CVS. That's what I would.
Okay.
They do have higher debt leverage. It is getting up to that 3 times net debt to EBITDA, which is getting to the upper range for sure where we would like to see it. But yeah, I think that it closer fits.
You have net debt to EBITDA of 3.2 times.
Or sorry, 3.2 times. Is that what I said? Around 3 times?
Mm-hmm.
Is that what I said? Yeah, 3.2
3.2
times. So it is getting to the upper end.
I don't think that's too bad. I mean, given they also have a retail element to their business as well, it's pretty capital intensive, so we'd expect some debt. I don't think that that's too bad. I mean, you're right 100%. The balance sheet on UNH is much better in terms of just lower debt leverage. But I mean, I wouldn't say that CVS is out of line or speculative. Certainly, I wouldn't want to see the leverage go much more. I'd probably say, around 3 times. So maybe they're just would be more ideal. So, maybe they're just above that. But, as one of the things about UNH is I remember looking at them, they have a technology services element to their business as well. Do they not?
I'm not sure. Yeah, that would be news to me.
Something. Yeah, need to refresh myself
Further dig
on that.
Yeah.
But I don't know how significant it is in terms of contributing to the bottom line. So, I think just based off of the numbers, to really actually determine what company you would buy, we need to go much further in depth. But I think just based off of the numbers that you provided, the historical numbers, the valuation, I'd probably have to agree with you.
Well, thank you.
Well, I want to review the technology segment of UNH as well, because I remember thinking that was.
Yep. No, that's a good note.
Mm-hmm.
For sure.
Did you kind of faintly say that you agree with Brennan there?
I did not say that. I would never say that.
No. First time for everything. So that would be.
Of course, yes. Sometimes I do agree with Brennan. Right? Like I have a broken watch on my desk, and 2 times a day it is correct. So, 2 times a day I agree with that watch on the time.
Yeah.
So is he the broken one, or are you the broken one? Who's who here?
Brennan's the broken one.
Okay, just making sure.
Now we're just harping on Brennan. Which, is our favorite pastime here on KeyStone.
It's love.
Podcast.
Yeah. But on CVS, do you know if they're floating rate debt or are they
that would be another good thing to look into, of course, especially with rising rates, that'd be a great thing to look into.
Most companies have a fairly small, a smaller proportion of their debt variable relative to fixed, but that'd definitely be something to know. And as well is when is it maturing, right? So if you have if you have some debt on your balance sheet that's fixed and it's maturing, in 5 years, well, it probably doesn't really matter what the.
But if it's 5 days,
if it's 5 days or if it's a year, you got a chunk of debt and you're going to have to renew it at a higher rate, and that can make a big difference for sure.
Yeah, for sure. All right, let's go to our stars and dogs segment. Our star this week is Winpak, a company we actually interviewed the management team last week. So we'll have some insights based on that. And our dog is a company called Nautilus, Inc., the well-known manufacturer of exercise equipment. Bowflex is a name that they own as well.
Yeah, so I will.
Brett's going to handle that.
Yeah, I was waiting for that. There we are. he forgot my name already.
That's true. No, I was just staring into space.
All right.
Brennan put me to sleep, let's be honest. So.
Oh, yeah. The usual.
Yeah, that's true. Anyways.
From our Stars and Dogs segment, it's time for this week's Star.
All right, so Winpak, our star of the week. While the TSX Composite Index has fallen 13% year-to-date, our star of the week, Winpak, symbol WPK on the TSX, has surged 23% to $45.66. The company manufactures and distributes high-quality packaging materials and related packaging machines. The company owns 12 production facilities located in Canada, the US, and Mexico. Its products include the packaging for perishable foods, beverages, and healthcare applications. The company is the opposite of the core losing stocks this year. It is the low-risk, consistent stock with a large cash position, unlike those SPACs we were talking about earlier, allowing it to avoid and perhaps benefit from the risk-off attitude of the market we've seen this year. We interviewed some of the management last week, and I can say that the mentality of consistent and cautious growth is built into the company. An example of them being cautious is the increasing of inventory levels to $260.3 million to minimize the impact of the ongoing global supply chain issues. Them being cautious does not mean they are not growing, though. Winpak grew its revenues by 27.2% year over year to $310.3 million for Q2 2022. The adjusted EBITDA grew 17.8% to $58.7 million, and net income grew 18.1% to $33.7 million, or 52 cents per share. This was on the back of an improved gross profits, as well as selling prices exceeding the impact of the rising costs. For further details, we will be releasing our Canadian Opportunities Report sometime in October, where Winpak will have an in-depth report. But until then, Winpak is our star of the week.
Yep. You want to go to our dog, then we'll comment on it fully?
We can do that. We'll do a full loop. Yeah, that works. All
Perfect.
right.
From our Stars and Dogs segment, it's time for this week's Dog.
So our dog, like Ryan said, is Nautilus. Once a pandemic favorite, Nautilus symbol NLS on the New York Stock Exchange has fallen 72% year to date to $1.67. Nautilus is a manufacturer of fitness equipment under the brands Nautilus, Bowflex, Modern Movement, and Schwinn Fitness and Universal, otherwise known as equipment many people buy once and only use once. Revenue has sunk nearly 70% year over year to only $55 million from $185 million. Net income was eliminated, going from a profit of $14 million to a loss of $60 million. That shift in earnings has eliminated much of the bull case for the company, although it should be said a major portion of the loss was a significant goodwill write-down of $27 million, which doesn't actually impact operations, it's just an accounting number. Further, we are going into increasingly grim near-term situation for the consumer cyclical products, which Nautilus products are a part of. The macroeconomic pressure will put further downward pressure on both the top and bottom lines of the company if the recession fears play out. The company has already been applying increasing discounts to its own products, which have already lowered its gross margins. The gross margins fell to 5.5% from 25.1% last year, with 11% of that drop, so about half, being due to the discounts. Worse to come, if the company continues in this manner, it will begin to run into the limits of its balance sheet. It may have been a pandemic star, but for now, Nautilus is our dog of the week.
Well done.
What are your thoughts on you own a Nautilus, don't you, Ryan?
Bowflex, not the stock, for God's sakes.
No, not the stock.
Because
so
let's just clear that up right now.
Product?
Yeah,
Yes.
no,
Did you buy it during the pandemic?
Mm-hmm. Yeah, but I'm not buying
once?
5 of them. No, I you know what? As a review of the product, use it like 3-4 times a week. It's great, like it.
Don't lie.
But,
For the first week.
Yeah,
but no,
first week.
Brennan hears me on it talking
That
to
is
him all
true.
the time.
That is true.
Yeah, but like it, honestly, it's good product. But the whole thing is like you don't keep buying it. They have a subscription service on it called the Journey service as well, right?
Mm-hmm.
But like, I mean, I don't care if I'm, somebody's yelling at me to, keep stepping. I don't know what the hell they're, piss off. I'd be yelling.
Have you used the subscription service, like the free trial or anything? Have you seen?
No, I didn't even. My family yells at me enough to just go on it, so I don't need them. They're like, get the hell on that thing. Get out of the kitchen or wherever you are in the house. Can you do it somewhere down near the beach? Not near us, okay?
Yeah.
Like they're yelling at me. But honestly, I think it would be beneficial for some people, right? For sure. But I don't need it. I don't need to pay that. So, I mean, that would be their ongoing revenue that they would get from you. So they're not getting that from me. They're certainly not like, I don't need 3 of those in the house. I need 1, right? And, even if we got another Bowflex or another Nautilus machine, it's a one-time purchase. And then, the product better
hope it's going to
last
last
for like
at least 10 years.
10 years or something.
In your case, 30 due to not being used for
non-use, right? It's because my cat got on it once. That's what happened, and that was about it, right? Yeah, no, but yeah, that's the thing. And we looked at this company in the middle of the pandemic, and the revenue numbers look great, the cash flow looked great at that time, the balance sheet looked great, but you look at a business like that, you have to actually, forecast going forward what is going on here. And, everybody was locked up at home. Nobody could actually go to the gym for periods of time. So people bought those devices in home, and it's not a recurring purchase unless you can get everybody into that, the Peloton type system. But, Peloton, got to massive valuations, has come down. Like, you guys have a bike, don't you? Aaron?
Well, yes, my wife.
Yeah.
My wife has a Peloton. Yes.
And you think it's in the house. There's a rumor of it.
I somewhere I have no idea where it is. Yeah,
that's true.
Oh,
Once
you
again,
I know the subscription service on Peloton, it offers a lot, but that alone is not going to be enough to maintain the revenue growth that they generated during the pandemic, right? So like there was this idea that, you know, the pandemic is going to change behavior. People were working out in the gym, then they had to work out at home, so they bought home equipment. And then, you know, they're not going to want to go back to the gym because now they like working at home. And I think that's true to an extent, but I think that like now that things have opened up, people want to kind of go back and do those things that they used to, like go to the gym, go to like live events.
Oh yeah, and I think there's a motivation going to the gym too, right? And if they have a trainer that says you got to come in, I mean, part of it is just getting there, right? And
well, that's what I do. I put on my workout gear, I go to the gym, and then I can say I went to the gym. I didn't actually do anything
at the gym.
I go to the gym 5 times a week.
You go in the spa room, you go in the sauna, you lay there. No, you just leave, right? I don't want to see people. Well, Aaron, you'd think Aaron would be one that maybe would just have a gym set up in the house, but the problem is he doesn't want to use that in the house either. So.
I think, well, my wife has figured that out. She knows that, you know, I'll put all the energy into building the awesome home gym, and then it will sit there.
Look at it.
Yeah, wonderful.
It looks really cool. We should get someone to use it.
It looks like it's brand new, untouched. 10, 15
It's part of the home
actually.
now.
Yeah, exactly.
It's just
we did the Peloton, and you know, I think once again, from a product review perspective, I think it's great. But so I've heard from my wife. But you know, it definitely, the sales that they generated, the product sales that they generated through the pandemic were not normalized, and you know, in a lot of cases now, these pandemic boom companies are having to give like a lot of that revenue back. So
yeah, and they've been cutting back their
drop
workforces too.
Yeah. The drop on Nautilus has been, I mean, it's just absolutely shocking. I mean, it's 90% from its peak levels. Like it, and like the guidance is not very solid going forward. I mean, and and they're like Brett said, the balance sheet is starting to come into question now, right? With the losses they're booking. So, maybe it has been a turnaround story in the past, but was that turnaround driven by the pandemic? And, is there, there may be some decent equipment there, but, the share price is just absolutely cratered. And it was one of those things that you had to, as an analyst, watch during the pandemic. Is this company getting some kind of, pandemic boost that is not sustainable? There's some companies that got a boost that was a little more sustainable. Like in this case, it was like one of the perfect cases of just one-time event, and now they're going to normalize back to levels aren't anything close to what they were at that point. And it's fairly foreseeable, to be honest. And the numbers look good, and the reason we didn't recommend it, because that was you could forecast going forward, people weren't going to just keep building up their gyms. Like I said, I don't need 3 of those Bowflex machines downstairs.
That's a lie. The reason we didn't recommend it is because Brennan said it wasn't a good stock. So Ryan and I were.
Yeah, that's true.
Basically.
That's true.
But yeah, I've got
Brennan's
a gym membership. Yeah, I don't need the home equipment. I'll go to the gym, see people.
And like as you said, Ryan, it's just at a certain point the numbers and the valuation looked really good, but the writing was on the wall in terms of the risk that revenues were going to drop. And when you're looking at financial statements, you always remember those are the past. You can use that past information to try and get a sense of where its company's going in the future, but you can't just extrapolate it going forward. It's the future financial performance that's going to drive the stock price, not what they did a year ago.
I even remember getting on a phone call with a client and Ryan, and they were asking us about Nautilus, and Ryan just basically said the exact same thing, at that time, and he never ended up buying it. Good for him, that's good.
And then we'd say it's a lesson learned if somebody did buy it at that time, but it's just the capital was destroyed at that point. And you have the markets. We always have to look forward. We want to look at, like, it had the good underlying fundamentals and numbers in that period that we would love to see in a company. You just have to see some level of certainty that there is some sustainability, and those were such unusual times, that you couldn't have any degree of certainty going forward, and that's what kept us out of the company.
Yeah.
Now let's Winpak. I mean, absolutely boring business, probably, we'd say, but like great numbers. I mean, they've had price increases, probably experienced a period where they had unusual pricing power, and that is not is not what they're going to have going forward. So it's something to watch on the company, but the way it's run in terms of a great balance sheet, they pay dividends very small. They pay special dividends when they build up cash. It looks, we'd love to see them be a dividend grower over the long term and have a policy like that. But, they're responsible to shareholders in that respect. And, when they make an acquisition, it's rare, but it has to be at a really good price, has to be fitting into what they are looking for in terms of growth, going forward. And it looks to be very well run, which is nice to see. We'd love to see it cheaper. That's what we'd say. We'd love to see it at a cheaper price, but for our clients, we're going to have a full report on the company in our upcoming opportunities report, which there will be some opportunities there. And Winpak is certainly a company that has been run well. We continue to expect it to be run well going forward and responsibly by management, which is, again, one thing we look for in a company, in a box we like to check off. And it was good to catch up with management, or introduce ourselves really to management over the past week.
Yep. Yeah,
all right. I think is that it for the show this week? We think so.
Yep.
Keep smashing that subscribe button. We want more comments on YouTube. Come in there. Tell us what you like, what you hate, mainly about Brennan. And so just tell us.
And Brett's cat.
Pixel.
And Pixel.
We want comments on Pixel. Many comments. Rate and review us on iTunes. Most important. Rate and review us on iTunes.
Comment. Send in your stuff.
Yes. Yep. Send in your questions. Your stock, our take. We'll answer those. Compare companies, and we'll have some news next week on our next upcoming DIY webinars and seminars. We're going to do a couple in person and our standard online webinars as well in the next month or so. So we'll have some news next week on that. Thank you, everybody, and for watching, listening, and I wish you all profitable investing.
Thank you all.
Thanks, everyone.
Thank you.